We had a couple that had some bad credit because it was back in the downturn in the market the last time, and they wanted to be closer to their kids and grandkids, so they wanted to move closer. They could not qualify for any traditional loan program, but we were able to purchase back in 2013 for this couple a $525,000 house. They've made no payments in 10 years, and now the property's over $1 million, and they have more equity than they did when they started the loan transaction.
Hi everybody, Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today we have the one and only Carlos Camargo, and he is going to be talking to us about reverse mortgages. How do they work? He's going to be going everything from A to Z, talking about how to use a reverse mortgage to eliminate your monthly payment, how to use a reverse mortgage to purchase a property, how you can even use a reverse mortgage to receive additional monthly income. So if you're a senior or know somebody who's a senior that could potentially benefit from a reverse mortgage, this is an episode that you want to watch until the end. So welcome to the show. Carlos, how are you?
I'm doing well. Thanks for having me.
I love it. So for our viewers that don't know who Carlos Camargo is, who is Carlos Camargo and how did you get involved in this wonderful world of reverse mortgages?
I actually have been doing reverse mortgages now 16 years. I never thought I would ever do one, not to mention be in the industry for the past 16 years. But it was my father-in-law that actually asked me to look into it for him. And at the time, I have my Bachelor of Science degree in finance, real estate, and insurance. And then I got my Department of Real Estate license, salesperson, and then broker license. And in '07, had my own mortgage company, and I didn't know much about the program at all. So I did a little bit of homework for him because he had three friends that all looked into the reverse mortgage. They all said it wasn't what they expected it to be, and they all got it, and two of them got licensed to do it to help some of their friends from their church and their spheres of influence. And so that was about 2007 that was my first exposure to the question of what I know about reverse mortgages.
Yeah, it's funny because sometimes when I'm even speaking with customers and I bring up a reverse mortgage, they say, well, I don't want to lose my home or I don't
Right.
want to leave my kids with nothing. And there's so
Right.
many misconceptions and so many different wrong ideas that people have about them that I think it's something that we need to explore. So let's just start off from the very beginning. What it is a reverse mortgage and what makes it different than a regular mortgage?
That's probably a good starting point. A reverse mortgage is the only loan that's specifically designed for older clients. Some people don't like the reference of senior because it starts at age 55 now. The government insured reverse mortgage is 62 and up. But for those individuals that are 55 years of age or older, the loan is an age-based criteria. So they look at, are you old enough to be able to qualify, versus a traditional loan is going to do underwriting and qualification based off of debt to income ratios, loan to value ratios, credit history to determine if you qualify. And then the better your credit, the better the rates and terms. The reverse mortgage, it doesn't matter if you have a 500 FICO, 800 FICO score, you're going to be able to qualify based off of your age. Again, 55 plus for the private, 62 plus for the government insured reverse mortgage. And then the biggest difference once you're in a loan, traditional loans require monthly mortgage payments. Usually it's due around the first. It might be a different day, but you get usually about 15 days of grace before the 5 to 10% penalty. With a reverse mortgage, they're optional mortgage payments. So for the principal and interest, you can make payments if you want to. Most people are doing it for cash flow, and so they don't make payments, but they're optional. They're not mandatory. You know, on a traditional loan, Jose Luis, you're going to have someone, if they pass the 15 days of grace, they're going to get that 5 to 10% penalty. If they're behind 3 months or more, you're knowing that they're going to have a notice of default and they can start foreclosure proceedings. And with the reverse mortgage, the only way that they can lose their house is the same way as a traditional loan. and that is if they don't pay their taxes and insurance and stay current on that. But they don't have a monthly mortgage payment, so there's no default for the principal and interest payment like on a traditional loan.
Got it. I love it. Now, when you say optional, does that mean that like I can make a payment today and then not make another payment for 6 months, and then 6 months later make another payment, and if I want to?
That's exactly what it is. It is optional payments that you can make payments at any time for any amount without ever any penalty. So again, the traditional loan is going to be looking at mandatory payments and the structure for, late fees and penalties. With the reverse mortgage, you can make no payments all year long, and then if you wanted it for tax purposes, you can make a large payment or any payment during the course of the year, and now you're going to be able to have that apply just like a regular loan, always to interest first before principal reduction. And with the reverse mortgage, there may be mortgage insurance depending on if it's the government insured program or the private program.
You know, it's funny. I actually didn't know that you can make payments on a reverse mortgage. So that actually makes it simpler for people because it almost like makes it so that, hey, I'm going to make my payment if I want to. But then
That's
if for
right.
whatever reason I get in a financial hardship, I'm not obligated to do it. So if they don't make their payment, what happens to the loan balance?
The loan balance is going to continue to accrue interest just like every other loan. But with the reverse, it's optional payment. So if you don't make a payment, your balance is going to go up over time. Traditionally, amortized loans, they go down over time. It's not a straight line down. It's, heavy interest in
Curve.
the beginning, finally principal reduction to zero over 30 years, for example. With the reverse, you'll see a rising balance if there's no payments made. We have clients that have purchased their home 10 plus years ago that bought their house, and now they have more equity 10 years later than they did from the beginning, and they've never made a payment once, right? We had a couple that had some bad credit because it was back in the downturn of the market the last time, and they wanted to be closer to their kids and grandkids, so they wanted to move closer. They could not qualify for any traditional loan program, but we were able to purchase back in 2013 for this couple a $525,000 house. They've made no payments in 10 years, and now the property's over $1 million, and they have more equity than they did when they started the loan transaction. So, yeah, it just depends on how much equity is growing in the property and what their balance of the loan is. And, the difference between what your loan balance is, the value is the remaining equity. In this case, for them, the last 10 years, they've increased the amount of equity they have in their home and not made a payment in 10 years.
Which is awesome. So basically, if you don't make a payment, the loan balance goes up, basically. But there's potential equity appreciation. Now, um, what happens ever if I'm still alive and the loan balance exceeds the amount of equity that I have?
Yeah, one of the unique features of the reverse mortgage programs is what's called non recourse. It's just a legal term that means the banking industry has no recourse against the homeowner or against the family. And so on the government insured reverse mortgage, they have a mortgage insurance fund that protects in case of default. And the family, like when we saw years ago those short sales and deed in lieu of foreclosures where people owed more money than the house was worth, that could happen again if we have another correction, but the program pays the lender or the investor whatever that shortfall is. And so that's with the government insured. And the private reverse mortgage, they lend less money, charge a higher interest rate, and they have the same non recourse. The family's not on the hook if the home doesn't pay off the loan.
Well, I think where I was headed to is if I'm still alive, if that ever changes where now I owe more than what it's worth,
Right?
I can continue living there until forever.
Contractually, it's to age 150. They wanted to pick some year in the future And I had 3 clients that were over 100 years old. So that was one of the reasons why they didn't stop it at age 90 at 100. So technically, they can go to age 150. We got to go back to the Bible to see people live past that age. But yeah, they can continue to live in the home for the rest of their lives as long as they continue to stay current on the taxes, the insurance, and HOA if they have any additional payments.
Got it. I love that. So basically, if somebody, this is a, uh, who is this product perfect for? Like meaning, like what type of situations does a reverse mortgage typically help people in?
Great question. Um, give you a little bit of history before we go there. The first reverse mortgage was done back in 1961. So, part of your question earlier about the misconceptions, it's been around for a very long time. It wasn't until Reagan's administrations in the 80s, in 87 and 88, when it became a federal loan program and the government insures their version of the reverse mortgage. They call it a home equity conversion mortgage, or HECM, HECM for short. And the reverse is unique in the ability to be able to have such differences compared to traditional lending programs. And we used to see homes where people had a lot of equity, and maybe their cash flow position was not ideal, or they were short and they needed to supplement their retirement income. Today, we're seeing a wide variety of clients, from the cash poor needs based borrower all the way up to the affluent and mass affluent client. Our private reverse mortgages now will go up to $4 million cash out, and it's all tax free, just like other home equity loans. So it's no longer one size just for the desperate person. I used to hear it called a product of last resort. Do that, before you file for bankruptcy, or these other extreme cases when it's just the opposite. One of our clients locally here in Oxnard Shores, she had a $9,000 monthly mortgage payment on a $2+ million property. And so we did the reverse mortgage to pay off $1.2 million in loan, which she was pulling that money from her brokerage accounts. And so she was having to liquidate 12 to 14, maybe up to $15,000 a month to pay the 9,000
Mortgage.
plus. And so it's not one size anymore. I see a lot more differences in who we service.
So
It
basically,
just depends on what they need.
so if I'm understanding you correctly, if somebody maybe is barely making ends meet and wants to get rid of the mortgage payment, they can use a reverse mortgage. If somebody wants to purchase a property, they can use a reverse mortgage to purchase, which we can go into detail on how that works.
That's
And then
right.
if somebody maybe wants to get rid of their monthly payment or needs additional income, can a reverse mortgage actually pay you money as well too, or no, on a monthly basis?
Absolutely. They set it up that you can be able to receive money in the following ways. You can be able to get a lump sum cash at closing if you want to pay off debt. I got a client that wants to pay off $70,000 of revolving debt. You can be able to take monthly payments. This is what the TV commercials really talk about, is supplementing the retirement income. And you can take monthly payments for a specified term, number of months, number of years, or you can set it up like an annuity stream of income for the rest of your life that you live in the house. You can have a line of credit where you use the money when you need the money. And or you can do a combination of all the above. You can take some money, have money in the line of credit, have money every single month. It's the most flexible loan program that exists today.
I love it. So, like, let's say somebody has $1 million property paid off and only is receiving $3,000 from Social Security. With inflation, they're finding themselves in a pinch. Gas prices, food prices, they can be receiving an additional stream of income of $2,000 potentially. Now, instead of three, they're at five, and this has helped the monthly cash flow position if they want it. That's amazing. Which we're going to go into details in all of those. Before we do that, is there a reverse mortgage program where they actually pay your taxes and insurance to help the cash flow position?
There is. So
Okay.
we've had some clients that have little to no income, like you described. Social Security might be their only source of income. And 2017, they made some changes to the reverse mortgage program. And one of those changes was the implementation of like an escrow impound account where they'll pay your taxes and insurance. The biggest difference between a normal escrow account where they're paying taxes and insurance is it usually just add a certain amount to your monthly payment. With the reverse mortgage, they look at your life expectancy. Some of them call it a life expectancy set aside, and that's where they'll set up and make sure that there's money so that they can never go into default. So yeah, we have clients, Jose, that don't have a monthly mortgage payment, don't have taxes to worry about for the county property taxes, and don't have to worry about insurance. They'll all set that money aside. Now, if they're on Social Security only, now they can live on just that money, and or maybe they supplement and receive additional money. Yeah.
I love it. And they can make a payment at any time, right? So essentially, if they're like, hey, look, my financial situation has changed, I can make a payment and then the loan balance doesn't go up anymore. So who
They can
does
make
not?
interest only payments, principal and interest. Again, any payment, any amount, any time without ever a penalty.
I love it. So who would not qualify for a reverse mortgage?
If you default on a federal loan, you're not going to have an easy time getting another federal loan. Um, Bankruptcy clients, if they have discharged their bankruptcy, it depends on Chapter 7, Chapter 11, Chapter 13. There's differences on when they can reapply for, they got to reestablish their credit first, right? But some allow discharge of the bankruptcy with shorter periods of times. 11 and 13, I think it's up to 3 years you have to wait. So it just kind of depends if there's derogatory credit and whether or not there's any sort of underlying factors. If they have the ability to show, let's say it was a husband and wife and one spouse was battling cancer or other medical costs, medical related bankruptcies for seniors is the fastest growing bankruptcy. If that was, someone that had extra medical costs, they can be able to just do a letter of explanation and explain it. So we still do a financial assessment of all borrowers, but it's not an automatic denial like you'll see on working with traditional loan officers that say, okay, I can't touch anything under 640 FICO, under 580 FICO. Ours is an evaluation. What happened? Is it likely to happen again? Is the reverse mortgage able to help them financially so that they don't have financial problems again? And again, if they don't have a monthly mortgage payment, they set up taxes and insurance, then it makes it a lot easier for them to be able to recover.
So low credit, no income. That's not a deal breaker.
Not a deal breaker.
I love it. I love it. Good. Okay. So I had this recently. I had a client that was thinking about selling maybe in 2 years, and they're like, well, maybe I should not get a reverse mortgage because they said that the fees were a little bit higher than a traditional mortgage. What do the fees look like in terms of a reverse mortgage?
Great question. Because of the different programs that are available, the fees can be zero cost, low cost, or higher cost. And they're similar to other FHA loans for traditional loans. Because of that mortgage insurance premium, that's the extra fee that most people, kind of get upset with. It's a 2% fee for upfront mortgage insurance premium on the purchase price or appraised value, whichever is less. So on the government loan, if you have $1 million+ property and the new lending limit for reverse mortgages is just north of a million, it's 1,089,300. You're going to now have $25,000 to $30,000 in total fees for origination, third-party fees, and the mortgage insurance premium. On the low end, the private reverse mortgages again can waive almost everything, and sometimes they do, especially on the larger transactions. If you're taking out millions of dollars, they'll waive the fees associated with the cost, and now it's less than obtaining a traditional loan.
And can these fees be included in the loan or do they have to be paid out of pocket?
The vast majority of people finance the
The
fees.
fees.
The only two fees that the federal government would like you to pay on the government insured loan is the appraisal inspection and the counseling fee. The counseling fee is less than $200. It ranges 125 to 175 with most of the counseling agencies. In our area, Oxnard, Ventura, most of Ventura County, we see around 700, 750 for appraisal. But both of those fees can be financed as well. So if it's a financial hardship, they don't want the homeowner or the potential homeowner to suffer and not be able to move forward with the transaction. And so we can cover all the fees and closing costs.
I love it. So let's talk about purchasing a property with a reverse mortgage. How does that work?
Yeah, the TV commercials are only going to really talk about in 30 to 60 seconds the refinance transaction. But years ago in 2009, they came out with a purchase option because they saw a lot of fixed income retirees having trouble qualifying for traditional loans. And so we used to see people buy the house cash or 70%, 80% down, and then do a reverse mortgage to pull their money out. And the federal government wanted to come up with an option, the purchase option, so you didn't have to have two sets of escrows, one to buy the house and then one to refinance and pull the money out. So depending on the age of the borrower or the borrowers, if there's more than one, they are going to get money from the reverse mortgage loan. They usually get that in a one lump sum. And then they bring in their money so that they have equity or a skin in the game. And now they're able to purchase a property. And again, no monthly mortgage payments or optional mortgage payments.
Now, do they have to sell first in order to do that? Or can they buy first and then sell? Or how does that process work?
Yeah, it does not matter. It's strictly an evaluation of do they have the money. So we've had some purchase clients who had enough proceeds so it did not have to be a contingent transaction. We don't have to have you list and sell the property first to be able to purchase, especially in this environment, right? You're not going to have any problems listing and selling a property with the shortage of inventory, but finding home of choice is the challenge for most of our clients. So if we're able to purchase the property that's going to be their primary residence, then that is what usually they try to do if they have the funds available. And so we have inheritance, other people acquire funds, then yeah, they're able to purchase without it being contingent. But we also have, Jose Luis, the clients that need to sell their house to be able to buy another house. It just depends on the person's situation. We had a widower that he lost his wife. He was living in Orange County and he wanted to move closer to his family, his kids, grandkids, and he had a couple of great grandkids. And so he had his property listed and sold in Orange County, and we did a concurrent transaction and closed here in Ventura County.
Got it. Now, I know this probably depends on age, but what type value to loan ratio do reverse mortgages look at? Like, meaning, like, if I owe 90% of what the property is worth, am I a good candidate for a reverse mortgage or not?
At 90%, you're not going to be a good candidate. Right now, with interest rates rising, it's an algorithm, a formula that they look at the interest rate of the program, the age of the borrower. There's a bunch of different factors, which they call principal limit factors. You and I just want to know the loan amount, just like my clients want to. They want to know, Carlos, how much money do I need to bring in for this purchase? How much money can I tap into my equity for this refinance? And so it's not a easy number like a 20% down client. You got to have 80%. It's not like that. It's based off of age. Just use this as the rule of thumb. The younger the borrower, the more equity they need if it's a refinance, or the more money they need to bring in on a purchase transaction. The older they are, so again, someone in their 50s needs more equity. It might be the other way around. They need 90% equity. if they're that young. It might be more like 30%, but uh, someone in their 50s doesn't get as much money as someone in their 60s, 70s, 80s, or 90s. The federal government has this crazy matrix. It's like a spreadsheet, and they look at interest rates from 3% to double digits. So each eighth of a percent has a factor, each age group. It's a pretty complex factor. You just want to make sure you're working with a trusted reverse mortgage professional who knows what they're doing.
Got it. So basically, and just for our viewers to understand that, I'm talking about like the amount of equity that you have in the property. What he's basically saying is that if you're younger, you need more equity. That way you can make no payment for longer if you don't want to make a payment. And then if you're older, less equity is okay because obviously life expectancy, it has to do with life expectancy, what they look at.
Just
Um,
like insurance with actuaries that crunch the numbers, that's exactly what they're looking for. As we said before, you can live longer, right? You're not going to get cut off, at 100 or anything like that. You're going to just be able to have a certain percentage when you're applying for the loan. The old rule of thumb was to subtract 10 or 12 from their age. So if you wanted to really be conservative, if you had a 72-year-old, subtract 12, it would be like 60% was the amount that you could qualify for. But with interest rates rising, that's dropped. And so it's probably more like 40%. And so, again, you need more equity as your younger ages compared to your older ages. And as interest rates rise, the amount that you get as a loan amount decreases. And so that's where it's dropped from being able to get 50% of your equity, 60%, and now it's 30, 35% at the lowest ages at 62.
I love it. So, talk to us about the option where reverse mortgage gives you a lump sum or pays you monthly payments, or the annuity type where it's until you are no longer alive. Talk to me about that.
Yeah, let me use an example of a client that just called yesterday. She's 68 this month. She's a widow, and she's got about $70,000 of revolving debt, including her car. And for her, she wants to be debt free, right? So she does not have to worry about the pinch of inflation that she's already feeling. So she's going to use $70,000 to pay off all of her debt. And now she'll free up thousands of dollars every single month in the minimum payments that she had on all of her debt. She's going to have a line of credit about $185,000, and there's about $500,000 set aside for inheritance purposes. So you mentioned it earlier. Some kids misunderstand the program and they think they're not going to have any inheritance money. The government doesn't let you get all of your money. They let you have a portion of your home equity. They convert that into this mortgage, and it's based off of the age. So for her, she's taking a lump sum. She's not sure if she wants monthly amount, because if she doesn't have to make those payments, she thinks she'll be fine. But she's got an extra $185,000 in the line of credit, and that will compound and grow. There's a growth factor. It's unique to the reverse mortgage lines of credit. Traditional lines of credits are a line up to a certain amount, up to $250,000, up to $100,000. You can use it for a certain period of time with interest-only payments, and then it recasts to principal and interest payments. And those can be frozen, can be reduced, or closed. People who've been in real estate long enough probably remember Countrywide, and how Countrywide, before it defaulted, did exactly that. They froze people's lines of credit, reduced it to the actual balance before a lot of them called the loan and closed it. With the reverse line of credit, that doesn't happen. It's guaranteed.
Got it. So, what does it mean? You said that you can set aside 500,000. In that case, what did that mean? And it sounds like in this case, she took a lump sum, and then she also opened up an equity line of credit, and she opted not for the monthly payments. Maybe you can give us a scenario where somebody opted for the monthly payments after you tell us about the setting aside 500,000. I didn't really grasp that 100%.
Yeah. So on that example, the property value is about $780,000, right? She's
Mhm.
not able to tap into all of the equity, right? So that's where they set aside about 500,000 of her equity. That's hers, but it's reserved that she can't use at this time. The other side of the pie chart is what she can use, and that's where she was using 70,000 lump sum. She used the line of credit feature, because the line of credit, you can withdraw money from that line of credit anytime for any amount that you have available in the line of credit. And it's usually 3 to 5 business days. The servicer will send that to your checking account. They just want to make sure it's authorized by you or, power of attorney.
And in this case, she basically does not have to make a payment until she dies, basically, if she doesn't want to.
Yeah, that's exactly it. She does not. Remember, there are optional monthly mortgage payments for principal and interest. She's got to stay current on taxes and insurance. She doesn't have an HOA. I'll give you a different example for your monthly amounts. I had a financial advisor in Westlake Village, and his client was a high seven-figure, high client of his, but he was in that sandwich generation. He was caring for and paying for his mom at the tune of about $4,500 a month for her caretaking expenses, and he also had his own kids in college and stuff. And so here's our high net worth client who's sandwiched by having to help pay for mom's care and also
And
his
the
own
kids.
kids. And so he was pulling money out of his brokerage account. Again, that's going to be taxed. And so he was having to pull 6,000 to 7,000 to net the 4,500. So we paid off the amount that he'd lent his mom. It was $135,000 at the close of escrow. We paid him that money back, and we set up automatic payments every single month directly into her checking account for 4,500, which was the shortfall. Sometimes 4,300, but it was not more than 4,500. And we set that up. And he said, Jose, Carlos, I didn't know how valuable that was until my mom got dehydrated, went in the hospital, and had incidental fees that weren't covered by insurance. And you had told me to put some money in the line of credit, not just to have the monthly checks. And he said, it worked just like you said. I had some bills, medical bills for her, and we just transferred that money from one account to another, paid them off. And it wasn't, his wife never thought that they would get the money back until his mom passed away. And yet the reverse was able to set up to make it work just like it's designed to.
I love it. Now, do reverse mortgages only work for primary residence, or could somebody do it on an investment property?
Yeah, it would be nice if we allowed it on investment property, but no. There was talk years ago that they might consider it, but it has to be a primary residence. You know this. Who generally takes better care of the property, a renter or the homeowner?
Yeah, 100%.
Now, you can be able to rent out rooms in the house, or the reverse mortgage can be on a duplex, triplex, or fourplex, as long as the homeowner resides in one of the multi units. Like if they want rental income in retirement, they can be able to get a fourplex, get 3 rental incomes, and live in the other and not have a monthly mortgage payment. It's an amazing concept to be able to take someone who's willing to be a landlord of their own property and be able to make some more money than they currently have.
That's actually a great product. And they can use that to purchase, right, as well, too. It doesn't have to be that you already own the fourplex. You can actually purchase a fourplex if you wanted to.
Yeah, I'm sure you have real estate investors, right? And that's a great strategy. The fourplex, being able to purchase it yourself. Again, the reverse mortgage money is designed without limitations. The only limitation they really are concerned about are when financial advisors direct their clients to take out a reverse mortgage so that financial advisor can invest it, right? The reverse mortgage has no risk of loss, but you can be able to do whatever you want with the money. So if you're able to obtain, think of the clients that are obtaining millions of dollars. 2 of my colleagues did transactions here in California where the client got $6 million tax free at cash out, and the majority of what they're going to do with that money is invest in real estate. And we've seen that in the past where people are able to make good investments. And you can't go anywhere else and borrow money without having to make a monthly payment and get all the benefits from the investment, like real estate.
I love it. I love it. So at what point does a reverse mortgage come due? Like meaning like let's say that I'm
Yeah.
at an age now where maybe I don't I move out of the house. I go into the hospital. I don't
Yeah.
plan on getting sick and I'm there in assisted living for 6 months.
There's three times that a reverse mortgage is due and payable. And it's the first one's the easiest. If you ever sell your house, you know this. Escrow is going to want to get a payoff demand of who is owed what. And the reverse mortgage is just like any other loan. It's a lien on the property that says that someone owes something. And so they're going to pay that off with, the sale of the property. The second one's unique to the reverse mortgage because it's an owner occupied loan. You're allowed to be out of the house for up to 12 months. So if someone went into assisted living, if they slipped and fell, went to the hospital, and then they had to go to a care facility, as long as there's an intent of the homeowner to come back, that's a lot of time. It's 12 months out of the property. Technically, they could go on that cruise around the world on the SS Rotterdam and be gone for a year, right? As long as they're coming back, this is their primary residence, that's good. And then death of the last person on title to the property, the last person, not one spouse, but the last person who's on the loan, then the family has up to 12 months to decide if they want to keep the house or sell the house. Now, they have to tell the servicer within a month, what they're thinking about doing. Hey, am I going to list it with you, Jose, and sell the property, or am I going to keep the property? They can get 6 months up front, and then they can be able to get 90-day extensions to go from 6 months to 9 months, 9 months to 12 months. You probably know this, but what happens to anybody with real estate in California who does not have a trust?
Probate.
Probate court system. Do you happen to know the average length of time for probate in Ventura or LA County?
To complete the whole thing,
Yeah.
you're probably looking at 12 months.
It's 18 to 22 months right now in LA and Ventura County. So the reverse mortgage payback just has to happen when it's allowed to happen. If someone doesn't have a trust, again, we should always recommend people meet with an elder law attorney or get a trust done. But if they don't, it's going to probate court. And so that 12-month window is not going to be attainable. And so they can keep on extending it. I saw a client here locally in Port Hueneme. She was a non-borrowing spouse, meaning it was her husband. It was his reverse mortgage. She had married him after the fact, and she stayed in that property 6 years after he passed away. It's not something they like to do, but they don't want to evict and foreclose on someone anywhere in the country unless there's due cause. And I don't know how she got it extended that long, but it was over 6 years.
How was she on title or no?
No, but community property state here with us in California, like others, is she was trying to claim that she had a vested interest in the property. There was no trust. Again, it's going to be mitigated through probate court, and it was complicated. And yeah, normally, 3 to 6 months. You can get extensions up to a year, but again, they just want communication with you and the servicer. What's happening, right?
Yeah.
If it's stuck in court, you're just updating the servicer and the investor. It's stuck in court. The loan continues to accrue interest until it's paid off. So there's no recourse. So they're not too worried about that. From a financial standpoint, investors love this program because they can't lose.
Yeah. What about let's say that mom passes away, um, and let's say that mom owes more than what it's worth, and I want to buy the property. Is there any sort of incentive or discount if I wanted to buy the property?
Absolutely, especially with some of our clients that have owned the property for 20 plus years, 30 plus years. I have a client right now going through a divorce. So it's not a death, but kind of play this scenario. She's been married 30 plus years, community property with her husband. The property taxes and insurance in Santa Barbara is less than $500 a month. For her, she can't live anywhere else. She wants to pass it on to her daughter. So I'll take your example of the death of the last person. You can have a family member decide that it's important for them to retain the home. Maybe they grew up in the home and it's got emotional, attachments to it. The loan's just not transferable. I served in the military. VA loans are transferable. My VA loan's 2.375. If I sold my house, anybody wants that loan, right? But the reverse is not a transferable loan, so it just has to be paid off. If you had a death or a transfer that stayed in the family, there's also benefits of them being able to have the property taxes continue within the family instead of being reassessed because it's not sold outside the family. So there's lots of reasons why a family might want to retain it. Your second part of the question was, what happens if the person owes more money than the house is worth? This definitely happened in 2007 to 2011, where we had the peak in 2007, the bottom 2011 for most areas in the state and other areas. And people owed more money than the house is worth. Remember, the reverse is non-recourse. So the government insured reverse mortgage, the HECM program, pays back the investor the difference, whatever shortfall amount there is. There's no having to negotiate, like, remember short sale days where you had to go and petition the investor? It's not like that. Here it's just, okay, what is owed, what is going to be received, and the difference is paid. Now, here's one of the unique things for any heirs and beneficiaries if they want to retain the property, to include if they owe more money than a house is worth. The strike price for them is 95% of fair market value. So they don't pay what's owed. They can do fair market value and be able to retain at 95%. So that's an extra benefit. Again, no other lender does that.
And then at that point, they just get a new loan or whatever they do at 90 and they buy it 95%. So here's something I wanted to ask you. What's the difference between the government insured and non-government insured? And how does that program vary?
Well, it's varied over the years. From 1961 to 1987, there was only the private reverse mortgage system. So a lot of our misconceptions or myths about today's reverse mortgages are really before Reagan's administration stepped in. Probably the biggest problem with the loans back then, Jose Luis, was that they could foreclose on seniors back then. They could be able to do equity sharing. Equity sharing is popular again right now for people to tap into their equity. But the Reagan administration and that Congress said, listen, this is just a loan. We're going to be able to charge interest, mortgage insurance, like other programs. And you're not going to be in this competitive situation where they want 50% of the appreciation as their cut for giving you 50% up front. So today, the private reverse mortgage programs almost mirror the federal government's program, but they're designed to really go to higher levels of property value. Again, the private reverse mortgage, you can have a $10 million estate. Here on the Riviera going up Santa Barbara, Montecito, the beach coastal area, Ventura, the hillside communities, the nice community, Spanish Hills and in Camargo, you can have multiple $1 million properties, and the government insured reverse mortgage only looks at the first $1,089,300. The value could be higher, but they're only going to count the first million for determining how much proceeds you can get as a loan amount. The reverse mortgage, that's the private reverse mortgage, again, is going to look at a couple of different factors, but they'll look at the full value. The client I had at the beach that had a $2 million property, she did a private reverse mortgage to get $1.2 million. She couldn't have got that with the government insured reverse mortgage. And the other big difference is that the government uses a private mortgage insurance. It's a it's it's an MIP. It's a mortgage insurance premium, and again, it's 2% upfront, and then there's an ongoing fee based off of the loan balance. Whereas the private reverse mortgage, they don't charge mortgage insurance. They just charge a higher interest rate, and again, they'll go all the way down to zero fees. And so those are our two big differences. Is the valuation could be so much higher on the private, and count valuation above $1 million. The government insured only is under $1 million. The government insured has lower interest rates than the private because, again, they're mitigating their risk that way.
I love it. Good. Is there anything that we might have missed or anything else that you think would be valuable as it relates to reverse mortgages?
It can be used strategically for a lot of different reasons. We had a widow. She was about 79. She lived in a 2-story condo in the San Fernando Valley. I think it was Granada Hills. And unlike some people who are trying to downsize, she wanted to upsize. She wanted a nicer home. She wanted a 1-story home in Thousand Oaks. So she sold her condo. This is a few years ago in 2020 for $455, but her home in TO was $775. And so for her, she hasn't made any payments in the last couple of years, and the property is now $1 million plus home. And so for her, she wanted to right size. She wanted to move up in value, move up in neighborhood, nicer home. We have a lot of people that are trying to move closer to family, but some they're trying to move closer to friends. We had a married couple in their 70s move from Simi Valley to the Toluca Lake area of Burbank. Then they followed their friends out to Palm Springs, and that year was 12 weeks over 120 degrees, and they moved back to Simi. We did a purchase reverse for each one of their transactions. I told you about the widower. We have a lot of widows that want to move closer to family or friends. And again, it doesn't matter if they have bad credit. It could be used for divorcing clients. The one that I'm doing right now, she's 61, so she's not eligible for the government insured, but she's eligible for the private reverse. Owned the property 30 plus years, and she does not qualify for any traditional loan. But the reverse goes by age, and so we're able to take money out of the property as a refinance. It's $1 million plus in Santa Barbara, free and clear, and she's able to pull money out to pay her spouse as part of the dissolution of their marriage. He now will be able to go buy a different home, and he is 62 plus, so he could do a reverse mortgage or he can do a traditional loan. You might also have younger clients. We just had a client in San Diego, a reverse mortgage client, access $600,000 of their equity, and they gifted it to their son who had never purchased. He's in his 50s, and he could not purchase an $800,000 plus home, but he got $600,000 as a gift from his parents. And so, how would you like to be able to have your clients, whether they're parents or grandparents, be able to help with first-time home buyers so we can get them in? Because they don't always have to have 20% down. You worked with other lenders, you know that. There's 3.5% down for FHA. There's 0 down for VA. There's a lot of different programs with down payment assistance, but this is a way where we can now be able to help people. I've had estate planning. I've had people say, if I don't have to pay cash and I have all this extra money, I can start gifting my kids and setting up college savings plans. Again, the reverse is just a strategic financing tool that has more benefits, and more people should be looking at it today because I don't think most people get it. I mean, I had a degree in finance, real estate, and insurance, my broker's license, my own real estate company, and I didn't know. I was this close to being cynical. I thought it was a ripoff. I thought it was a scam. And it wasn't until I got educated where I started to try and help other people understand it. And fast forward 16 years now.
I love it. So, Carlos, if people wanted to connect with you or get in touch with you, what's the best way for them to do that?
We have an office here at the entrance to Ventura Harbor. They can call our office line 805 985 2808. We can meet here in our office face to face. Unlike 70% of our industry that uses a call center approach, I'm old fashioned customer service. I'd rather meet with our clients. We can often meet in their own home. We can meet at third parties like the real estate professional like yourself. We can meet at financial advisors, attorneys' offices. Um, and so I'm on LinkedIn, Facebook. They can look across social media and be able to find me. If nothing else, just search Carlos Camargo, Reverse Mortgage Ventura.
I love it. I love it. So, Carlos, I wanted to say thank you for taking the time to be on the show. I appreciate, obviously, you sharing all this information. For our viewers out there, we had Carlos Camargo with Open Mortgage. He talked to us about reverse mortgages. He talked to us how they work, went over, explained how you purchase a property with a reverse mortgage, how you can gift money, how you can receive a lump sum, and how you can also use it as a monthly stream of income. Once again, thank you so much, Carlos, for being on the show. For our viewers out there, if you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful to somebody else, make sure to hit that share button. Thanks again, Carlos. And to our viewers, until next time.